Welcome out to Trading Coaches Playbook. If we haven't met, my name is Tony Benson. I'm going to be your guide for today. And the last couple months, we've covered some pretty heavy stuff, especially when we're talking about the macro picture. So thought maybe it'd be a good idea just to go kind of back to the basics today. But it's never good to go refresh on the basics, right? So the macro picture is not very pretty. So it'll be interesting to see how things play out and how the overall economy goes, which doesn't necessarily on a short-term basis. It's not super critical, but it's important to understand, at least have a basic idea of what may be coming down the pike, right? It's one thing I've talked about before. As traders, we have to have at least a little bit of vision, be able to look out in the future, say, okay, here's where we were, here's where we're at, where might we be going from here, right? And then you get in the way of that. So that's really when you break it down to its simplest form, that's what we do as traders. So, but before we get too far into that, let me get the disclaimer out of the way. I'm not a registered broker-dealer investment advisor. I'm not going to give any recommendations or advice. Everything we do here is purely for educational purposes. If I do happen to mention a trade, just assume it is a paper trade or practice trade. For regulatory reasons, we do not discuss funded trading. Interesting. No surprise. The Russell's bouncing to the 200. So here's what's coming up in the next few weeks, I believe. Premium online workshops. So Patterns in a Flash with yours truly. That is this evening at 8 p.m. So if you're not in Patterns in a Flash and you want another free hour of instruction, then jump on the trial with that and play around with the tool a little bit. And if you like it, keep it. If you don't, no harm, no foul. So, but that is tonight, again, at 8 o'clock Eastern time. So I will be back here having some more fun. 2 in a day, that doesn't happen very often, but I like it. Inner Circle, August 21st and 28th, that's 7 o'clock Eastern time. Mastermind Group, the 22nd and 29th at 8 o'clock Eastern time. Monster Market Movers is August 23rd at 8. And Trading You is the 31st at 8 p.m. And of course, Power Option Plays are Tuesdays and Saturdays. Cover Call Explore is on Thursday. And the free online workshops, Power Hour every Monday at noon. Trading Coaches Playbook, this one right here, every Friday at noon. And Becoming a Pattern Whisperer, that is also with yours truly. That is, I believe, Monday, isn't it? The 21st is Monday, I think, at 8 o'clock Eastern time. And then Protect, Preserve, and Win in Uncertain Times, August 29th and 30th at noon, and then August 31st at 8 o'clock Eastern time. And then, of course, E-Mini Think Tank with Brandon every Monday, Wednesday, Thursday, and Sean's Vegas Spread Mastery Monday, Tuesday, and Friday. I really had wished this market would keep on tanking, but I'm not surprised that it's bouncing back a little bit. Can anybody tell what side I'm on? I've been on that side for 2 years now. So it's been on the sidelines for a couple of months for the most part. But you can find us on all the different social media pages. And then the 3 classes I have, Patterns in a Flash, which is, again, the one tonight. We have a 1-hour quarterly class for those that are subscribers to that. If you haven't had that tool, I'll show you a little bit of it here in a little while. There's basically about 8 hours of video, flashcards, quizzes. I'll show you the quizzes. Actually, I forgot to get logged in there, and the Weekly Whispers is another quarterly subscription. We're basically every single week, I go through and take all the candidates I have that I'm finding for my own trades anyway, and basically just doing about an hour-long video, showing you everything. I go through the macro picture, the big picture, the top-down analysis, right? We look at the big picture and then narrow it down to each individual trade that we're looking at for the next week. So, and then I do an update middle of the week. So, the small account, big returns. This is a class I did. It's a recorded 2-hour class about if you have a small account, how to handle that, right? It's a little bit more challenging to trade with a small account. At the same time, it really shouldn't be, because the process is the process, right? Trading is trading, whether you're working with $1,000 or $1 million. It doesn't really change. And frankly, if you go back, eventually, if you are starting with, say, 1,000 or 2,000 or a small amount of money, you will hopefully look back and recognize that it was a blessing in disguise. You may not think so. I remember thinking when I started back in 2000, man, if I just had 50 grand, I could kill it. because I only had 1,000, right? I was 24. I was broke when I started. I had to scrounge up some money to start trading with. And it was brutal. And it was very different then than it is today. To start with $1,000 back then was virtually impossible. I mean, it was very, very difficult. I know some of you are saying, well, why? What's the difference? Well, how much are you paying for commission today? 59 cents a trade or something like that, or a buck or two per contract, 50 cents a contract. I don't even know what mine are, because I honestly don't pay attention to them, because when I started, the cheapest commission I could find was $75. That was the ticket charge. And I think I had up to 10 contracts for that. If you went over 10 contracts, it was $2.50 per contract. So to do one contract was $75. I mean, if you buy one contract of an option, it has to move 7 points. Actually, it's got to move, well, what's the numbers? I don't know, whatever the math is. It's a lot, okay? Because that was 75 to get in, then 75 to get out. So it's $150 to place one trade. If it's one contract or 10 contracts, and you have $1,000, there ain't much there. I threw it into 2 different trades, and two months later, they expired worthless. I was like, well, that was fun. Let's go do it again. Right? I didn't know what I was doing. I was young, stupid. Now I'm just old, and anyway. So today it's significantly easier because the commissions they're virtually nothing. I mean, when you come from where I came from, how would you try to figure out how am I going to overcome this massive commission with this tiny amount of money? Today it's very, very little. So it is easier. It's not easy. It's just easier today because your commissions are, a buck or two, maybe $5 per trade, which you can overcome pretty easily, right? So that's a class I did because I know I struggled when I started. And again, if you start with 1,000, you grow it into a big number. You will be thankful you started, because it forces you to be more disciplined. You can't just throw money out there willy-nilly. And every time I think about that, it reminds me of a gentleman I met, I don't know, it's been probably 15, 20 years ago, at a workshop, a live workshop. It's probably 2005, 2008, somewhere in there. And he said, I turned a $600,000 account into $100,000 in 6 months. Oh, wow, nice job. And kind of laughed because if you didn't catch that, 600 to 100, he lost $500,000 in 6 months. And the reason is because he was a doctor and he was successful in his medical practice. And he thought because he was smart and he was a doctor and he was successful in this, he thought that automatically would translate into success in trading. And so he just went at it full bore and lost his shirt. Talk about humbling experience. That's the beauty of the market. That's one of the great things about it. It is the great equalizer. It doesn't care where you come from. It doesn't care what degrees you have. It doesn't care what experience you have. It doesn't care what language you speak. None of that matters. It is the great equalizer. The market cares about one thing. What's your skill level? That's it. That's all the market cares about. That's the beauty of it. So it doesn't matter what you've done in life. It doesn't matter where you come from. It doesn't matter your experience, your knowledge. None of that means anything. Now, kind of the opposite experience, I had a gentleman, I think it was in Chicago, and this I think was in 2008, came back after the 2-day workshop and said, give me everything. Just threw his credit card down, said, give me everything I need, all the tools, 25 grand or something like that. And we ended up chatting. He was the last one there. And it turned out after I got to know him a little bit, he said, I have 3 PhDs. I'm worth 8 figures, 10 million plus. I've made all my money in real estate. I know it inside and out. And I've always wanted to learn about the market, but I've just never had the time. I've been so busy with that business. And he said, frankly, with my financial background, 3 PhDs, and a pretty healthy chunk of wealth, and his financial experience in the real estate market, he said, I thought I'd come in here and pick up this information and just be off and running. And he said, my head is just spinning. He goes, I have no idea what I just learned. I'm just lost. And he goes, I didn't expect that. He goes, I know I'll figure it out. I just got to sit down and go through it and learn the materials. But honestly, he goes, I came in with a little bit haughty, if you will. He was like, pretty humbling to come in and learn a bunch of stuff that you thought would be easy and is actually a lot more complicated. So, you know, if a guy with that kind of background, they're just kind of opposite stories. And I think it's interesting to see the two. So the market will definitely humble you if you haven't already had that experience. But let's get to it. Oh yeah, I just saw your comment, Brenda. Yeah, that's not a bad side to be on in the environment we're in right now. So because the market looks like the sentiment's been changing a lot in the last week, which is what I've been waiting for. I've been kind of on the sidelines for a couple of months, just going, you know what? I'm waiting for some kind of signal, some kind of indication, and it finally started to show up a few days ago. And so I was for the most part flat for about 2 months, and now I am pretty heavily loaded up. And I might, if we have time, I'll maybe show you some of I'll show you the practice trades we've got on in the deal. So when I said back to basics, I meant basics, which isn't bad, right? And if y'all have stocks, we'll look at these because it won't take long to get through this. I think a lot of you, I see a lot of familiar names. I know a lot of you probably are very familiar and comfortable with a lot of this. But horizontal support and resistance, right? We'll go look at some chart. Actually, we'll just do that now. But this is something that I look at. It's pretty critically important to put at least the major spots on there. And that's really all I look for. Support, resistance, and trends. If you're not familiar with this, well, actually, I've got one example I'll show you. It just popped on my radar this morning, and it actually plays out beautifully. So, in fact, let's just go look at it. So we'll start with horizontal support and resistance. Where's my charts? There we go. That is definitely not it. Lennar. And this is an interesting one. And I don't want to get too far off, but the real estate market is certainly in a weird place. And it's kind of started to come together for me, and I'm starting to see what I think is going on, at least analysis. Because you hear a lot of people saying, well, the real estate market is, you know, it's still strong and it's going to stay steady and prices aren't going to drop, and because supply is tight. Well, that is true. Supply is tight. Supply is low, but so is demand. Prices don't go up when demand isn't at least higher than supply. If they're equalized, if supply and demand are equal, then prices will be stable, right? Theoretically, that's the way it should be. If demand increases and supply is short, then prices will go up. If demand drops off, even if supply is short, it doesn't matter because the demand is lower than supply, which means the prices naturally will have to come down to meet the demand. That's the way stocks trade. That's what a market maker does. If they have demand for a stock, they keep raising the price. They raise their bid and ask higher and higher. And the more demand shows up, the higher they raise the price. If the demand slows down and stalls out, the demand sinks below the supply, then they start to lower their price. So the stock naturally starts to drop. So there's a lot of these people, and I'm not trying to pick on them, but as traders, we've got to learn to peel the onion back and look deeper and figure out what's happening, because you can say, yeah, supply is tight, but so is demand. If you only look at one side of the equation, you're coming up short-sightedness, right? You got to look at everything. And I'm looking at these home builders, and you look at Lennar, and this thing's at an all-time high. And I just noticed it a couple weeks ago, 3 weeks ago, maybe a month or two ago. But and I'm going, this is just kind of goofy. On one hand, it's like, why are these home builders? Because the real estate market, while it's still relatively steady, why are the home builders tearing it up so much? And then you put two and two together, you go, okay, existing home sales aren't going very much. Why? Because if you have a 2 or 3% mortgage, are you going to sell your house? Not if you don't need to. Why would you? Right? Why not keep it? It's cheap money. If you don't have a need to move, you don't have a desire to move, then why would you trade in a 2 or 3% mortgage for a 6 or 7 or 8% mortgage? So there's a ton of people just hanging on to their homes. And in reality, there's people that have, maybe, I know the second half of the boomer generation is starting to hit retirement age. And they're at that place where they might want to downsize, But why would you downsize if, first of all, you only have maybe 100, 200,000 left on your mortgage, your rate's at 3%. Even if you sell your house, you take the equity, roll it into a new house, and you take a loan, you put all the cash into a new one, you take out a small loan on that at 7 or 8%, your mortgage is probably still going up. Your mortgage is going to go up for what reason? Why would you increase your mortgage by 500 or 800 bucks a month as you're going into retirement? You just stay put, just stay in the house, even though you maybe want a different one. So there's a lot of that going on. And then, excuse me. So why are the new homes selling like hotcakes? Well, the existing home supply is tight. So if people want to buy a house and they can't find an existing home they like or they want, or if they don't want to have an existing home that may need some work. And I met a gentleman several weeks ago, and started having a conversation, and he was 60 or 62. He was going to retire in a year or two. He lived in an old house built in the 60s that needed work. And he said, when I'm going to fix income in my retirement age, I don't want to be fixing up a home. So he's buying a brand new house for his golden years when he's retired, so he doesn't have projects all the time. He's going to rent that house out, because why sell it? Why not just rent it out and cash flow it when he has a cheap rate? And you start to get these little anecdotal pieces of evidence. You put it together and say, okay, that's why the home builders are tearing it up. Not only that, they're giving huge incentives. People that are selling, they know supply is tight, so they're not willing to drop their prices. Right? They're not, but demand is low too. So they don't have to lower their prices yet. Once supply goes up, which I think is pretty close, because I keep an eye on Zillow. I just poke around now and then. And you see the little red dots. If you ever get on there, little red dots of homes that are listed. It has increased dramatically in the last couple of weeks. Usually about once a week, I'll get on there and just poke around. And all of a sudden, there's like 10 or 15 new dots showing up in just this one little area that I just keep an eye on around my place. And I'm like, wow, that's a lot of new supply in the market. And again, it's anecdotal, but so the new homes are going because existing homes aren't selling. And you've got certain generation of people that are buying it because they don't want fixer-uppers. So it certainly made it interesting. But there's a lot going on with here with Lennar. Getting back to the topic, Brenda. It's an interesting dynamic, and it's really weird. And the question becomes, if the bottom falls out of the economy, what happens to those new home builders? Are they going to continue to crank them out or not? But let's get to, so I jumped off the PowerPoint to get back to here. So basic support and resistance. How many points does it take to draw a line? Y'all should know this, unless you're brand new. This is your first time in the workshop, but if you've been around for even a couple of weeks, I would hope you know this by now, but you can draw a line with 2, right? Here's 2 points. You can draw the line, right? They're not exact because they rarely are. You can draw a line with 2 points. It's not confirmed until you get a third. You got ahead of me there, Jennifer. You knew that was coming, huh? Trying to beat me to the punch. So in other words, a line can be drawn, whether it's a horizontal support or resistance or a trend line. You can draw it with 2 points, but there's no confirmation until you get a third hit on it. And in this case, you can see here, and I went to weekly, but we basically got kind of a double top there. We got 2 hits on it, but there's also a third hit here. So if we zoom in a little bit. And this is another thing too that's important, and you've all probably heard me say this. And I'm pretty sure it was John Murphy that said it. I remember reading in his book. Trend line, support line, resistance line should be drawn with a crayon and not a pencil. Okay. In other words, there's a little bit of a range. They're not precise. If you're getting down to the penny and saying, hey, resistance at 113.51, and you put your stop at 113.52, you're probably going to get stopped out a lot, right? You haven't heard that? I've said it quite a few times, but maybe it is good though, right? And that's why it stuck with me. I remember, and that was right after I started. So that was back in 2000 when I read his book, and that, for whatever reason, that stuck in my brain. Because when I started out, I was like that. I was like, this is the exact, because I'm a little OCD and I'm a little ADD, and I'm a perfectionist. And it's like, I need it exactly where it needs to be. It needs to be perfect, right? If it's not perfect, I'm doing it again. And I've had to learn the hard way that you got to give a little space, right? It's not bad to be a perfectionist, but you've got to learn to balance that out too with there's a little bit of range there. So support resistance is more of a range than it is a precise line. But you've got two hits here, which was a nice looking double top. This is the beauty of patterns right here. Right? There's a double top and boom, it just tanks, right? 110 down to 65. But when it comes back up to that same level, it challenges it again and it stalls out. Now it did pull back just for a little bit before it broke out, but it recognized that spot. So now you have confirmation this line is a solid line, which means that if this thing continues to fall, it will probably find a little bit of support here. It doesn't guarantee that it's going to. If something happens, if news is bad, if the market's crashing, this thing could just crash right through it, right? There's no guarantee that it's going to stop on it. It reminds me of another time. This is 20 years ago, probably. The guy, he's help me analyze this chart. Okay, we go to his computer, look at it. And he says, well, it's this and this. He draws some lines. He said, well, it's going to bounce here. It's gonna, huh? Well, yeah, look at, there's a support right there. Look at how many times it's hit that. Okay, it's gonna bounce there. Well, yeah. And about 3 or 4 times, I kind of was playing with him a little bit, but at the same time, I was trying to make a point. Well, yeah, it's gonna bounce there. He started getting angry. I said, so you're 100% certain it's gonna bounce there? Well, no, there's no certainty. Well, you kept telling me that it's gonna. In other words, what he was conveying to me is that he was convinced and he was communicating with certainty that it was going to bounce there. And so I was trying to open his eyes to the reality that just because you draw a line there doesn't mean you put a floor in. It doesn't mean it's going to bounce. It means it could. It means that there's probably decent odds that it will, but it doesn't mean it will. Right? So keep that in mind. And that's a mental trap that we all get stuck in sometimes. You convince yourself that because that's there and you're so convicted that you're certain, and that's a bad place to be. You've got to be adaptable and be able to shift gears. So, but one thing I always do when I'm analyzing, I go back and look historically for major support and resistance levels. The next level, let's say it does go crashing through there. You can see here, there's a resistance area, hits it, falls back, comes up and tests it again, falls back, and then breaks out of it, and then pulls back after it breaks out and uses it. The old resistance becomes new support. That's the old role reversal, right? If you're not familiar with that, then you definitely need patterns in a flash. But it bolts up from there, and then we hit that resistance, then we come back down, and we finally break back below it, and then it comes back up and finds that level again before it drops off. And then when it comes back up, where does it test? Right there. And you can start drawing lines. You can put a lot of lines on there. There's another, that's a relatively decent spot. It's not super solid, but if we go to candles, and there's the question a lot of people come up, and I think I'm getting ahead of myself here, is do you draw a line? Do you draw your support resistance on line charts or candlesticks? I start with line charts because that's the close, right? And then, especially considering this is a weekly chart, and then I will go to candles and see if they're valid, if they're more valid than I see, right? Because we've got a valid line here, right? 2 hits, 3 hits. We've got a valid line here. This one's even more significant. It's got more hits. Again, I'm getting ahead of myself, the PowerPoint to show this, but the more times it hits a line, the stronger it becomes. So you only got 3 hits on this line here, about 113.50, which means that it may not hold, right? This is not a super strong line. If it comes crashing through there, 1, 2, 3, 4, 5, 6, 7, you got several hits on this one in the last 2.5, 3 years. So this 104, 105 range is significantly stronger than the 113.5 area. Now, if it was to crack 105, the next level, which is decent, is about 95. But this is also something you will notice nearly all the time. It's not very often that it's not. You'll notice that these distances are equidistant, right? 95 to 105 is about 10 points, 104.5 to 109.50, 9 points, 10 points. That's extremely, extremely common. Now, you could draw a whole bunch of lines in here, and you could go here and go, oh, look, there's, you can put stuff in here. And sometimes if I'm going to do that, and there's definitely a spot there, but this is not as significant. I don't see it, so I will make it a small dash. If it's more significant, I'll make it large. That way, when I go back I can remember, okay, when I was analyzing this thing originally, I didn't see this as a very strong support line. That's just me for my own thing, because when you go through, 300 charts a week and you get down to 20 or 30 and analyze so much, you don't always remember. You go back to it and like, what was I thinking? So I just do that for myself, just so I know. But then once I've drawn the lines, I'll go to candlesticks, and you can see that there was somewhere. Yeah, here we got a hit intraday or intra-week, I should say, because these are still weekly bars. And you could realistically take this minor one and move it up just a little bit, and I will adjust it, especially on a weekly, because the daily, once you go back to daily, it will be, there's a little bit more action on there a lot of times. So in fact, let's do that. Go to daily. And so now there's those lines we've drawn on the daily charts. And now you can adjust them too if you need to. I mean, the ultimate goal is to get as many hits on it as possible without digging up something that's not there. You know what I mean? Have you ever done that where you hunt for what you want to see, not what's really there? And that's a big challenge that we have psychologically as traders, is you want to see what you want to see, right? You want it to be what you want it to be, not what it is. And we've got to make sure we stay on that side that here's what it really is. That's why sometimes people are like, oh, you're such a Debbie Downer. It's like, you know what? I can't control the overall economy. I'm just looking at what reality is, and I'm prepared for what I think is coming. I don't want that to happen, but if it does, at least I'm ready. And I'm in a position to take advantage of it. So that's essentially horizontal support. And let's clean those off now. And jump to trend lines. Actually, no, I take that back. Let me get one thing first. One thing with trends that you will notice is that when you make a new high, and this is just basic horizontal support and resistance, if it breaks above that high, for example, this one here, we made a high, we pulled back, and then we rallied and broke out of it. The breakout, that previous high, is often where it will be support if it pulls back. And you can see, this is why I laugh when people say, oh, that charting stuff, and not many people say it now, but 23 years ago, some people still consider charting to be voodoo. Seriously, I became a broker after about a year and a half of trading. And excuse me, you go through a week-long course, right, to learn to pass the test, which this will tell you everything you need to know about brokers. The lady that taught the week-long class, the first thing she said after introducing her and saying her name is that I'm not here to teach you about the market. I'm here to teach you to pass the test. Your firms will train you on what they want you to sell. Brokers are licensed salespeople. That's all. And the licensing part is nothing more than covering their butt. That's all it's for. But I remember getting into a debate with this guy who was a big fundamentalist. He used to be at a hedge fund or something like that. And I started showing him technicals, and he's like, yeah, well, what if you can figure out up here when the stock's way up here that the sales are dropping and this, that? Because we just looked at a basic channel, right? I said, okay, how long is it going to take you to do that research? I don't know. I'm like, well, didn't you work at a hedge fund or something like that? And don't you have experience? So you should have an idea of how long it's going to take you to figure all that out. Well, probably several hours, maybe a couple of days. I said, okay, I'm going to spend 5 minutes. I'm going to look at the chart, draw a support line. And if it goes down there and hits that line, starts to bounce, I'm going to pick up a trade, put a stop below there. I'm going to spend 5 or 10 minutes, not hours or days. And if it breaks below that, I'll get out and I'll lose a little bit of money. Fine. How much? I mean, if I lose $500, you spend 2 days of time. How much is your time worth? So it was an interesting debate, but now technical analysis is pretty mainstream. Even Kramer started to talk. He used to say that it didn't work, but now he does it. I don't know if he's gotten any better, but I saw him years ago and it's like, oh my gosh, this guy's embarrassing. But that's me being a perfectionist, right? So this is very common. And you can see that when you get a breakout to the upside, what is likely is you'll get that previous high as support. And we can go along this whole thing. And there's one right there. It breaks out. And it breaks out of there, pulls back, gives a little tiny roll reversal right there. Let me make this bigger so you can see it a little better. right? So it spikes here, we go sideways for a little bit, breaks out, taps it a little bit, rallies, comes back, dances on it twice, nice little double bottom before it launches. And then it breaks above this high, the previous high. Where does it pull back to? You can see it doesn't look like it hit it, but it actually did 2 or 3 different times. And now you can just keep drawing lines. You go, okay, there's the previous high. Boom. When it breaks out of there, what does it come back to? Right there. And this time it wasn't as precise as it was here. This was nice, but it's still same area, right? Here's the high. We haven't quite got there yet, but we're sitting right in that area as we speak. I don't know if I didn't get that in there. So this area, this 115, 116 area may act as support. I mean, obviously a huge drop off yesterday. So when it comes to trends, that is one way that you can find candidates. If something's in a trend, you know, if you get in and we get a breakout here, it pulls back, you go, okay, there's an entry, it bounces on it, you put your hook up here, it grabs your hook, you buy some calls, you buy the stock, whatever, it runs up here, you bank some profit, you wait for it to come back. A million different ways to do that, right? Now let's look at trends. So same basic concept with regard to trends. You could draw a trend with 2 lines, 2 points, but it takes a third one to actually confirm it. Now there's based on the close. Now we go to candles. And this is where, I mean, obviously this is very subjective, right? There is now it's more of an art form, right? Technical analysis is an art form. It's not a precise science. That's one reason I'm not a big believer in the old black box systems, right? The whole algorithmic trading systems, the red light, green light, whatever you want to call it. They're all based on objective data, and they can't account for human emotion. And human emotion is what drives the market. So while they can be effective in certain markets and certain market conditions, long-term, they always break. At some point they break because the objective data can't measure the subjective emotions that people have. And when people panic and freak out, that's when those systems break. And frankly, that's when most people get their head handed to them, is when the market panics and freaks out and they don't know how to handle it, especially if you're a proverbial bull. If all you do is trade the upside, you don't know how to trade the downside, and you're not ready for it, you're not in position, you don't have some kind of hedge in place, then you're getting your head handed to you and you're freaking out as the market's going and you're panicking, and then you panic at the last second and sell, and that's when it turns. Right? You've all probably been there if you've traded a little bit. But there's no objective way to measure human emotion. So so the question becomes, do we adjust that trend line or not? And we could. I mean, you could realistically adjust it up to here and say, well, you've got some more hits, but it depends on how pure of an analyst you want to be. Because some technicians will say that if it even breaks it intraday, that's a valid break of the trend line. Some will go off the close. Realistically, if we go here, there's only 2 hits on it. So we don't have a third hit on it. In fact, it just literally broke it yesterday, even though it's not technically even a valid trend line because we don't have a third confirmation on it. But yesterday, I think, was very telling. And I think it's very interesting that today, and that is today's candle, right? It's about a 15-minute delay. We gapped down, rallied up, and look at where we hit. Literally tagged that line. And it's rolling over. And I wouldn't be surprised if trying to see where it's at right now, 116.63. Well, it's ticked up a little bit. It's 20 cents higher than it is right there. So we'll see how Lennar plays out. But so as far as trend line goes, that's basically it. So this is the trend line's there. I don't put a whole lot of emphasis on it, but the fact that it broke it with big volume is fairly telling. And there's one other thing that some of you maybe noticed, maybe some of you didn't. Does anybody see a pattern there? It's not beautiful. Whoops, that's not what I wanted. Yeah, that's too easy for you, Trip. I love it, Les. I don't know if I should say that or not. He says M for murder, which is what I've heard that before. It's been a long time since I've heard that, though. Stock's going to get murdered. So it's essentially Head and Shoulders. It's not beautiful, but it's definitely there. And then this is what you learn in Patterns and Flash: is not only how to recognize them, but also how to trade them. So there's the measure move. I think it's got to be pretty close to that. So if it breaks, which it clearly did, that's about where we would expect it to come to. And I would actually move that down here. I'd probably put it right there. Oh, you know what? That's one thing I forgot to put in the PowerPoint. Yeah, I knew that. So yeah, it's not a beautiful Head and Shoulders, but it's definitely there. And again, it's a massive break with lots of volume. If this thing rallies back up into this 120, 125 range, especially if it taps that neckline, anywhere in here, really, that's where I would look at playing something bearish. Whether you do a bear call spread, if you're a spread trader, have at it. I buy calls and puts. That's 99% of my trading. But whatever position you choose to take, if it just keeps falling from here, then it's too late. The pitch has gone by, and it is what it is. But the other thing too, real quick, before I forget, because I just realized I didn't put this in the PowerPoint, even though I intended to. Gaps, also known as windows, right? Depends on who you're talking to. All right, the Japanese call them windows. The translation from in Japanese, the translation for gap is window, essentially. I think is what it was. It's been years since I read those, but they call them windows. We call them gaps. Potato, potato, tomato, tomato. But gaps often will act as support levels especially on a short-term basis, not necessarily on a long-term, but they can, and they don't always, obviously. And I'm looking at a bunch here, and there's really not any that are great examples. But what I'll show you is there's a little window open here, right? So it breaks to the upside. If this stock was to pull back, that little area, the top end and the bottom end, either one of those could act as support. That whole range is kind of a support level. Well, here's one that did play out. Let me get rid of those, actually. I just noticed that. So you get a gap from there to there. Excuse me. It dances around for a few days and then pulls back, hits the bottom end of the window, and then rallies from there. I guess here's another one too. If we come down, there's this little window right in here. I'm trying to make that bigger so it's a little easier for you to see. So you got this little window here. It gaps down. There's an opening there, gap, and boom, it drops off. And then a couple of days it bounces back up. This time it uses the bottom end of the window as resistance. It drops from there. Here's one that didn't, right? We got this little window that opened. It didn't pull back even close to it. Let's see if there's other ones. Here's an open window that it didn't even recognize it. It just went blasting right through it. So generically speaking, that's how you will look at the gaps that you have. The small ones, even the big ones can do that sometimes. So you would see those are best on a short-term basis. Not something you're going to look at long-term. So how do you gauge the strength of a support and resistance? And I touched on this a little bit. The longer stock trades at support or resistance, the more times it hits it, or the longer it's there. So if you have a 10-year period and it's hit that level several times, it becomes more and more significant. That's why when you see me analyzing a chart, I will always go back and look at the entire history of a stock. Because that was one of my big questions when I started was, how much time do I look at? And I still get that question sometimes. How long of a chart do I look at? 6 months, 2 years, 5 years? Well, if you're using Omega charts, it's extremely simple, right? You just hit a couple of keystrokes. D is for daily, W for weekly, M for monthly, Q for quarterly, and Y for yearly. So I literally hit W and it expands the chart and gives me several years. And if that's not enough, if it's a company that's been around for a long time, I hit M for monthly, and now I see. And then I will draw the major support and resistance that are relevant at the current time. And then I'll bring it back in. and narrow it down and make them get it a little bit tighter. But the longer spends hitting that support or resistance, the more valid, the more significant, the stronger that area becomes. The number of tests, the number of times it's hit, right? If it's only hit 2 times, it's not even a valid support or resistance yet, or trend line, same thing, right? Once it hits a 3rd time, now you have a valid line. If it hits 17 times, that makes it extremely strong. Horizontal support and resistance, you'll get that sometimes. You'll get that many hits on it. A trend line, it's pretty rare. Trend line, if you get 3 or 4 hits on it, that's pretty solid. Well, you saw Lennar, we had 2 and then it broke. So it wasn't even really technically a valid trend line, even though it's there. I guess you could say that it's doing a role reversal. So it came from below and recognized it. It looks like it's recognizing it at this point. Volume, if there's significant volume at the support or resistance level, that makes it stronger. The heavier the volume is at that level, that means there's a bigger tug of war. There's a bigger fight between the bulls and the bears. And the more people that show up to that party to watch the fight and see who's going to win, the more they're going to fight, right? The harder they're going to fight to see who wins. And whichever way it breaks, obviously the other one's going in the pit, right? So the amount of volume that you have. And then the more recent activity typically becomes stronger, right? If you have something that just happened 3 months ago versus 5 or 10 years ago, because the 5 or 10 years ago, people forget about. But we have short memories. So you'll remember the stuff that hit recently, but not necessarily the stuff that happened a long time ago. I already hit on that. Yeah, I think we already covered all that. So I said I got ahead of myself. Surprise, surprise, right? For those of you that know me. So yeah, Lennar should be interesting. And here's what is also interesting. And I said this to my weekly whispers. Those of you that get yours today, you'll hear this again. If you already have weekly whispers, you'll hear it. But here's what's interesting. Not that Netflix, Head and Shoulders. It's breaking right now. NVIDIA, Head and Shoulders is starting to form. That's an ugly Head and Shoulders. I wouldn't even call it that. Double top. Head and Shoulders. Double top. Quasi inverted Head and Shoulders, but yeah, not really. Double top. Double top. Triple top. Head and Shoulders. Double top. I mean, they're not the prettiest of things, but there's a Head and Shoulders. Double top on Home Depot. J&J, this one is crazy weird. Look at that volume. Usually when you see big volume like that down days, they're sell-off days. You got 3 huge doji days, and the average volume is 5 times what it was a month ago. Just really weird. I don't know what's going on there. Double top, Head and Shoulders, Head and Shoulders. Was the beginning of a Head and Shoulders, but I guess you can call it a double top, but that's a stretch. Head and Shoulders on Merck, NASDAQ, ascending triangle, one of 2 bullish candidates out of 31. Head and Shoulders, descending triangle, if you will, kind of. Head and Shoulders on Pinterest. It's a wonky Head and Shoulders, but it's the beginnings of a formation of a Head and Shoulders. Another beginning of a Head and Shoulders. Starbucks that's just, I don't know what that is. Double top, maybe a Head and Shoulders if it forms. Head and Shoulders on Wayfair. So the last time I remember seeing this many reversal patterns like this with Head and Shoulders and double tops was at the beginning of 21. That's when I turned really bearish. The end of 20, I started to see some signals that we were probably going to get bearish. 21 is where a lot of Head and Shoulders showed up. Peloton, I remember that well because I traded it. It was at 175. And where's it at now? $10? I mean, looked at Peloton. I mean, I would have, should have, could have. If I could go back and buy a giant leap, I would have. But I thought I had it on my list here. I think that's not going alphabetical. Can't do it right. Yeah, it's on there. Where'd it go? $7. Let's look at it. Actually, what's going on here? It's not working for me. There we go. Yeah. Well, there's one at the top there too. I got to back it up. That right there. It ran up and hit. I think it hit, I don't know if it hit 175, hit 171. It looks like it's the high. But that's a beautiful head and shoulders. And this was a fun little ride. This is why I love patterns. This is why it's important to learn patterns, because when you see them like this, you go, okay. And if it breaks the neckline, there's what happens. Not all the time. Obviously, they don't. They sometimes fail. Actually, more often than not, they fail. But you know what? This is 150 down to 100. And I didn't catch the whole thing. But that's a 33% move. It doesn't take too many of these to make up for a lot of failures. If you get 3 of these to move 15 or 20%, and you have 7 failures that you lose, maybe 1 or 2%, 3% on, and you make 100, 200, 300% on something like this, it doesn't take many of these to make up for a lot of little losers. That's the whole purpose of risk reward, right? So, but this type of pattern was showing up a lot. Home Depot started it was later that year, I think. Let's see, when was that? Yeah, it was the end of 21. But in 21, there was there's a big double top here, right? There's a lot of these patterns started to show up. And so it's kind of interesting going back there a year and a half, or I guess that's been 2.5 years now. And remember and seeing a lot of these patterns show up and going, it looks like the market is on the verge of heading south. And sure enough, in 21, you had a lot of stocks like Peloton, the little guys. That's when they got trashed, right? Home Depot, the big guys kept going. The Microsofts, the Googles, the Fangs of the world, they continued to go north. Where the little guys like Peloton, they were getting beat down the whole year of 21. Because yeah, that was the end of 20 actually when it peaked out. Well, I guess it was January of 21 when it formed. So that was February of 21 when it broke. And this is what a lot of these little stocks did. So it was only 22 when the overall market did, because like I said, the Microsofts, the Fangs that make up a huge percentage of the indexes, they kept the markets going north. So it looked like the overall markets were going north, when in reality, a big percentage of stocks were actually already in bear mode. So talc lawsuit sell off. I don't remember I don't know what that was in reference to. Is that Home Depot? Do I use a scan to find my candidates? Absolutely. And it's really simple. My trading is very, very simple. In fact, it's actually rather boring. For those that are in weekly whispers already, I've been on that kick lately. Sometimes I get on this kick. It's like, okay, are you ready to get bored again? We do the same thing every week. There's my list. There's my scan. It's optionable stocks. I have the volume set at 2 or 3 million. I'll adjust it sometimes if I don't have enough candidates. I'm usually looking for around 300 symbols. That's about give or take a little bit. Optionable stock, volume, and price. I think I got it above $20 or something like that. Again, I'll adjust it sometimes. And that's all it is. It's super simple. But all I do is go through these and look for patterns. I'll literally sit and just flip through it, and I'm looking at the right side of the chart looking for a pattern. If I see a pattern, I hit there's Adobe. I'll hit the space bar. You see the little check mark. I flag it. And then when I've gone through that list, which only takes 10, maybe 15 minutes, and all I'm looking for is a potential pattern. And then I flag those. I hit save, and that brings it into another list. And then, well, that's what you saw here. I date it. It's Weekly Whispers, August 17th. And this one, actually, I think I had 57 or 63 or something like that. So I flag the ones that I see, and then I come to those and I look at them more in detail. So I start at a high level, right? Top down, just looking for something that I recognize, something I see, and I flag it and then bring it in. And now I spend more time on each one. So instead of spending a bunch of time on 300 stocks, which would take forever, I only flag the ones that I see a pattern on. And then I come and look at those, and then I only keep the best of the best, the ones that are actually that look good. And I usually get about 20 to 30. And that's all I watch for the week then. So it's really very simple. It's not complicated. It's not hard, but it works. And you find a pattern, you put your risk reward, you put your trading plan on it, you draw your lines, you draw your support, your resistance. What's the trend? What's the pattern? Here's the expected move. Here's how long I think it might take. Here's the entry point. Here's the target, or the stop on the target, and then the entry is automatic. So it's very simple. It's really not complicated. And after, it took me about, 14, 15 years to finally realize that it doesn't have to be hard. It doesn't have to be fancy. Actually, the simpler, the better. I go back to, yes, it is. I go back to when I started sitting in this trading room between two Richards. And the one didn't use MACD. And at the time I was learning that MACD is the king indicator. Well, why don't you use MACD? Because I don't need it. I use RSI, but MACD is like the best. And they're just young and dumb and ignorant. And he looks at the other Richards and says, should we teach him the KISS principle? I'm like, what? Yeah, keep it simple, stupid. Okay. And so yeah, that stuck with me. A couple of great guys, great traders too. But let's do that. There's the Qs, which of course is going to look the same as the NASDAQ, which we got a double top on the NASDAQ. And there is a trend line there. And 1, 2, 3, 4 hits on it. So that is a valid trend line that's in place. It is much steeper than you would expect to maintain itself for a long period of time. And as you can see, we're 8 or 9 months and just broke it yesterday, and the gap down this morning, which isn't a surprise that it is finding support right here. Right? Previous high, so you get a breakout, you run up, pull back a little bit, then break out of it. So I'm not surprised at all to see this bouncing right here. I think we very easily could come all the way down to the 200-day moving average before we find any major support if this sell-off continues, which is, right now it looks like it's going to. Because the bulls aren't coming in and picking it up. Right? When you're rallying here, we get this rally, it stalls out for a little bit, pulls back, the bulls get excited. Hey, buy the dip, rouse a little bit, buy the dip, rouse a little bit, buy the dip, buy the dip, buy the dip, buy the dip, buy the dip. Uh-oh. The dip is continuing to dip. So the question becomes, at what point, the people that have entered the trades here, at what point will they start to unload their positions? When will they stop out? I wouldn't be surprised to see a bounce. We may bounce back up in this area. We could very easily come back up here to the 50-day, because this is a pretty significant sell-off. They don't often, usually when you get a sell-off like this, they will bounce some, a little relief rally, if you will. So that's kind of what I would expect. But if we stand here, if we dance on this line for a few days and we don't rally from here, then I would expect more weakness to the downside. And if it breaks the 355 level, really the next level is right about there, about 338, 340. So, and then Spider, which is basically SPX, right? There's we get another false breakout. Tried to break out of that 453 area and couldn't quite make it. Again, very similar, right? The next major level is, I think it's probably a little higher right about there, about 430, which didn't get that far away from today at 433. So it got pretty close, but the gap down a rally is no surprise. The question becomes, how do we close? Because if you put yourself into other traders' shoes, you go, okay, I shorted this thing up here. At what point do you cover your shorts? If you're a short-term trader, I'm assuming most of you probably are. You look at it going, I shorted at 450. It's at, it hit 435. That's $15 a profit. I'll take it. Right? So a lot of the shorts are probably covering right now. But then again, some of them might just be hanging on, looking for more downside. So I see a lot of times I talk about tug of war, the bulls and bears in the tug of war. I think right now, because the volume is light too. So it's selling off, but without a lot of volume. So the bears aren't really, there's not more bears showing up to the party. But the bulls aren't either. It looks more like a game of chicken right now. They're facing each other down, going, who's going to flinch first? So if the bears come out and say, okay, we're not flinching at all, it'll accelerate to the downside. if the bulls start to come in and they come in with a lot of force, if they finally start buying and start driving this thing higher, you'll probably get a decent pop, because then the shorts, the bears will come in and say, okay, I'm going to cover right now, and I'll wait for it to rally back up. But that's the thing. We never know, right? You don't know what's going to happen. I mean, there's literally millions of people out there trading. So we just have to kind of wait and see what happens to it and go from there. So clear as mud. Anybody else have any other tickers? We got a few minutes left that you want to look at. If you haven't, you know what, I was going to do that. Let me see if I can bring it up real quick. Here's what I'm going to suggest. If you haven't had patterns in a flash yet, I'm going to show you one area that this is what I would suggest you do. First of all, and I think Lee put the link in there. It's at the top, yeah. But so there's a link in there if you want to grab the trial. You get a 2-week trial, right? And quizzes. Grab the trial, put a reminder in your calendar to cancel it if you don't like it. No harm, no foul. Go in and do the quizzes. This will give you a good, because there's basically 4 different sections. I'll show you this before we go there. There's the videos, right? There's basic of trends, basic of candlesticks, price patterns, candlestick patterns. The quizzes have one for each of those sections. Go take the quizzes, and that will give you an idea where you're at skill-wise from a technical analyst standpoint. And most of these, I think they're 12 or 13 questions is all. They're right around 10, give or take. So again, it's just questions. You answer them, click them, then hit submit. It will give you an instant answer, tell you how you did. If you hit 100% on all these, on all 4 of the quizzes out of the 40 or 50 questions, then maybe you don't need it. But you got 2 weeks. There's about 8 hours of video in here total between all these. There's basics, and then every single pattern. These are the live classes. You can go back and watch these if you want. And then the flashcards, if you're not familiar with recognizing patterns. These are very simple, right? You use flashcards as a kid to learn math. You want to see the head and shoulders, click on that. And then all you do is training your eyes to see the pattern over here on the right side. It's on an automated timer too, so you can just sit there and watch it. It's a little slow for me because, like I said, I'm a little ADD. But this is a way to train your eyes to be able to recognize the patterns when they're on the right side while they're still forming. Because when I started reading about the patterns and learning about them. And then I got frustrated because I would see them, but I would see it too late after it already played out. And so I was like, I got to be able to recognize these patterns on the right side of the screen, because it doesn't do me any good if it was 6 months ago. So it's just a training mechanism. That's all it is, right? It's very simple. It's very basic. Like I said, I'm simple. I'm not a complicated guy. Meta. This is one. I breezed through it, but yeah, this at this moment in time, there's not much to do with Meta, at least from what I see. And this is the part that's just mind-boggling to me. And we came all the way down to $90. In less than a year, 350, 380%. Is that really justifiable? I mean, have their profits gone up 380%? And maybe the sell-off was overdone. But it just seems a little excessive to me. And I think a lot of these big tech companies are a little overblown, but we'll see. I think the AI thing it reminds me of the .com bubble. There's a lot of excitement around it, but I think it's a little ahead of its time. I think the energy and excitement and what people think is going to happen with AI and how much it's going to change things, it does. It takes me back to the .com era where people were so excited that if you had a .com behind your name, we'd run your stock to $4,000, even though it was only worth 0. So, and a lot of them went away, right? So, but as far as Meta goes, there's obviously a pretty significant resistance there, about 294. The next major level is 251. There may be a little bit right in this range. Go to daily and see if there's anything there. Yeah, those are gross. It's too much congestion. I don't like those. And most of the time, if it's not a clear, obvious line, I'll just get rid of it. I don't like having too many lines on there. In fact, these aren't even relevant right now. They've been there for a while, but because as I said, I'm a little ADD. And so if I get too much clutter on there, it just, it's too much. So I try to keep it neat and clean. What I would look for on this, and this is just my opinion, obviously, I'm not telling you what to do, is actually, that's probably a more accurate spot to put it right there. I would look for this thing if the market bounces. And this is what I would look at as far as trading goes. If it comes up, if it rallies back up here to this 290 area and gives any kind of signal, candlestick, I mean, here's an evening doji star, right? If you get any kind of bearish candlesticks, if it doesn't break back above this 290 and it hits it or dances around it a little bit, I would put a hook down here about 290, 286 or so, looking for the potential for it to drop back to this 252. Just a thought. We don't know what's going to happen with this thing. It could just continue to fall. But just look at it, very basic level. I mean, support resistance. If you consider this a double top, which is a little bit of a stretch considering that the second top is significantly higher than the other, but you could treat it that way. And this would be the midpoint. And if it breaks that level, then the odds are that it's head lower. And you've got, a little resistance there. It breaks out, finds support, comes back, support, boom. Of course, that's the pop from earnings. And we've cracked that level. So that 290 level is fairly solid. It's recent. It's there. So it just remains to be seen if it actually goes up and gives any kind of signal, right? Oh, so you already own it. Yeah. Well, with options, there's lots of ways to protect. You can either, you could collar it. You could do there's a lot of different ways to do it, right? There's a million different ways. A million different ways to do it. The question is, what do you want to do? Are you looking at, if you have tax implications, do you want to sell the stock? If not, you can always, use puts as a way to protect your profits. Buy some puts, and if it tanks, then you cash out your puts, and that adds to your, I guess you'll still have, you'd have profits on there to pay tax on, but so there's lots of different reasons that people sell or don't sell. But if you're trading it short term, then yeah, at this point, the whole market's starting to turn pretty bearish. So, and I got to look at this and then shut up. Apple, yeah, earnings just got trashed. It was trying to hold this level, 178. And then yesterday it broke down, which not a huge surprise. But, and this is what happens, right? It'll try to dig in at a support line. And if it can't bounce, it tried here and then it failed. That's usually a pretty bearish sign. If you get several days where it dances on the line and it can't make a move back to the upside, even to close that window right there, that's usually a very bearish indication. So this is no surprise. And I was actually looking, you can see I have a bullish plan on there in case it bounced up, which it didn't. And I should have flipped this over already. But at the same time, it's dropped enough where I'm not super excited about the downside on Apple. I think it's probably going to go down. But I also deployed enough in other ones. I wasn't going to, I'm saving a little bit ammo in case something else pops up that I really like. This one I'm not super excited about. So, oh, nice. That's always good not to have to pay tax, huh? All right. Now, everybody go out and sell this market right now. Short everything, especially the ones I'm in. I'm just kidding. All right. Any other real quick questions? Because I'm a few minutes over. So, anyway. All right. Well, we will hopefully we'll see you tonight at 8 o'clock Eastern time. And we'll have some more fun. We'll go a lot more in depth into a lot of the charts, a lot of the candidates that we're looking at for this week. So we will spend tonight's hour doing a lot of that. So, all right, y'all have a great day. And we will see you hopefully shortly. Yeah, you have a great weekend too. Thanks. God bless y'all. Bye-bye.